here today and the opportunity to go ahead and talk with you today regarding our universal life products. So let me see what I can do here about my screen here. Just one moment. There we go. You should be able to see it a little bit better now.
Yeah, it's full screen now. There you go.
Okay. All right. So what I want to talk to you about today is two of our universal life products. They are Guaranteed Universal Life and Guaranteed Universal Life Plus. And then I'll also talk with you about the accelerated rider for terminal and chronic illness that is included with that product. All right, so let's begin by talking a little bit about our two products. Basically, these two products are almost identical. Where the difference is going to be is where they are most competitive and some of the premium payment options. So, for example, our Guaranteed Universal Life product, it is very competitive if the customer is paying a lifetime level premium. It's also very competitive if they are between the ages of 45 and 75, and also very competitive when you're looking at $250,000, $500,000, or $1 million. Also, we strive to be competitive in the preferred risk class and also the standard risk class. And that is both true for standard tobacco and non-tobacco. We realize that most clients think that they're probably a preferred risk, but when it comes down to it, in reality, 75% of the cases are issued at standard. But we want to make sure that we're competitive in both preferred and the standard risk class. Now, when you're looking at our GUL Plus product, this product, again, it is competitive for lifetime level premiums. It's a little bit more competitive if you're looking at ages 50 to 70 in the $500,000 to $1 million bands, but it's also very competitive in the preferred standard non-tobacco and standard tobacco risk classes. So when you're looking at these two products, again, the products themselves are basically the same, but what you're going to want to look at is how the client is going to pay their premiums. Are they going to guarantee the coverage to age 120? If so, then the Guaranteed Universal Life is probably the product for them. If they are going to do a short pay, all that means is that they're going to opt to pay their premiums over a short period of time, maybe 10 years, 20 years, and have their coverage continue out to age 120. Or maybe they want to do a single pay, or they have a lump sum of money that they want to just dump in to the policy. The Universal Life Plus is probably going to be the product for them. So I wanted to point out those differences, first of all, in our product. But again, it's a universal life. So with this universal life, what's going to happen is, if you're familiar with universal life, it's not a term. It's a whole life, or it's not a whole life, but it's a permanent life coverage that's going to be guaranteed for the duration that they choose, whether it be guaranteed to a specific age or for a specific number of years or to age 120. It is going to build some cash value into the policy, not as much as a whole life policy would build, but it is going to build some cash value. So it's a great opportunity. I like to think of it as a product that's right in the middle between a term and a whole life, because it has the best of both worlds. And with the flexibility of a universal life, it makes it very attractive for your clients because you can tailor it to their specific needs. Now, one of the things that make our Guaranteed Universal Life and Universal Life Plus products very attractive is the accelerated death benefit rider for terminal and chronic illness. And I'll talk a little bit more about that in some of the upcoming slides. But first I want to touch on some of the other riders that are available, and some of them are even included with the policy. First of all, there is the waiver of surrender charges for partial withdrawals. What that does is it allows the client to withdraw a portion of the funds with no surrender charges if they are hospitalized or become unemployed, disabled, Maybe there's the death of a spouse or a minor child, or even physical damage of $50,000 or more to their primary residence. So they can tap into that without having to worry about surrender charges. There are 2 disability riders that can be added for an additional charge. They can't have both, so they would need to choose one or the other if this is a rider that they would want. The waiver of policy charges, it does just that. It waives the policy charges if the person becomes disabled. The disability continuation of plan premium rider, what that does, it contributes a specified monthly amount of premium to the policy during the period of disability. An amount anywhere between $10,000 and $50,000. There's also an accidental death coverage that can increase the benefit for an accident, and then there's also a child's rider that's available either in a $5,000 or $10,000 amount. Okay, so let's talk about this acceleration rider for terminal illness, first of all. So what we allow is we allow a maximum of 80% of the face amount, or $1 million in acceleration. So if the insured is not expected to live for more than 12 months, they can accelerate 80% of their face amount. So if they have a $1 million policy, they can accelerate $800,000. Okay. Previously, what we allowed was $250,000 of acceleration, and they had to keep a minimum amount into the policy, but we've definitely changed that. And this applies to all of our universal life products, the individual products. It doesn't apply to our second to die policy, so keep that in mind. Secondly, let me talk to you about our chronic illness. So they can accelerate if they are chronically ill, meaning that they're unable to perform 2 of the 6 ADLs, or they have a severe cognitive impairment. So they can accelerate 80% of the face amount, or $1 million, and that's subject to the annual cap based on the IRS per diem, which this year is about $120,000 per year. Now, this rider is on all of our individual universal life products. Again, it's not on our second to die product, but all of our individual universal life products. It's available in Florida. I'm not sure if you guys sell in Florida, but previously our chronic illness was not available there, but this new rider is. And as I mentioned before, the triggers, we've changed those to be more consistent with the industry and also to kind of mirror long-term care. So it's 2 of 6 ADLs, or severe cognitive impairment. Now let me kind of show you how this works by giving you an example. I think this is always helpful. So say your client has a universal life product with us, and the face amount is $500,000. So the maximum that they can accelerate cumulatively, so in total, is $400,000. Okay, so let's just say that the client is unable to perform 2 of the 6 ADLs, and they want to request an acceleration of $100,000. So remember, there's no charge for this rider. What happens is when they request an acceleration, we're going to apply an actuarial discount to that acceleration. And the way that is calculated is you take the discount rate, which in this example is 4.5%. That discount rate is based on the Moody's corporate bond yield, and then you multiply that by the current life expectancy of the client. In this example, it's 3 years. So we take 4.5% multiplied by 3 years, and we get an actuarial discount of 13.5%. So we're going to take 13.5% of the requested amount, so 13.5% of $100,000, that's $13,500 as an actuarial discount. Okay, so that is going to be reduce the acceleration amount. We're also going to charge a flat charge of $100. So the check that the client is going to get is a lump sum check of $86,400. They can use that money for whatever they want to use it for. If they want to use it to help pay for a nursing home, they can do that. If they want to take the money and hire a nurse and take their family on a vacation, they can do that. We don't care what they do with the money. Now, what happens through the policy then is the face amount then reduces by $100,000, so the new face amount is $400,000. They still have available $300,000 that they can accelerate in the future if they want to. Okay, so the way that works is they can accelerate once every 12 months. It can't be more, it can't be every 6 months or every month. It's just once every 12 months they can accelerate if they want to. And we will follow the process again if they request a second acceleration. They would tell us what amount they want. We apply a due actuarial discount based on the current year's discount rate and life expectancy, and we would calculate what the amount of the check would be and provide them that check. Okay?
Hey, Sandy, a couple questions that have come in.
Yes.
One is whether the discount rate is a floater or it's built into the contract.
The discount rate is based on the current Moody's corporate bond yield, but we do have in the policy that it cannot exceed 6%.
Okay. All right, that makes sense. And then also a question about the rider, the rider being available in California.
Yes, this rider is available in California.
Outstanding. Okay. All right, sorry to interrupt, but I wanted to get those covered. Carry on.
Okay, thank you. Okay, so let me just talk a little bit about the chronic illness rider and how it differs from a true long-term care policy or a long-term care rider that's on a life policy. So with our chronic illness rider, there is no upfront cost for this rider. It's automatically included with the universal life coverage, where a long-term care rider, generally there's a recurring charge for the coverage, whether it be taken out of the policy's cash value or whether it's just flat charge for it. You're paying for that long-term care rider regardless. With our chronic illness rider, the benefit amount is flexible. So the client decides how much money that they want to accelerate, based on the per diem per year, of course. So they might want to accelerate $50,000 one year, the next year $100,000. It's completely their choice. All right. Where a long-term care rider, typically it is a predetermined amount based on when the policy is issued, whether it be a flat percentage of 1 to 4% of the face value or just a set dollar amount. There's typically not the option to take a lump sum or to increase the benefit once the policy is issued. Okay, so our rider, the benefit period is flexible. So again, multiple accelerations are allowed, and it's completely up to their discretion. It just can't be more than once a year, but if they want to accelerate 1 year, 3 years later they want to accelerate again, they can. Where a long-term care rider is basically set for a number of months, whether it be 12 months, 24 months, 18 months, whatever it is. Our chronic illness rider, there's no restrictions on how the benefits can be used. So as I mentioned before, they can take the money, they can make some home alterations if they want to, go on vacation, whatever they want to do with that money. In a long-term care rider, basically they pretty much have to use that money that they're getting for qualified long-term care expenses. They have to provide receipts and show where this money is going, and that it's going to long-term care expenses. One of the nice things about our chronic illness rider is that there's no long-term care continuing education required because it's on a life insurance policy is the chassis. It's a chronic illness rider. It's not a long-term care rider. When we look at the underwriting for our rider, we underwrite for the life insurance part of it. So our typical life underwriting is all that we look at. We don't ask but if they happen to be rated up, maybe to a Table 4 or Table 6, Table 8, that does not exclude them from getting this rider. It's still included with the policy regardless of the risk class that they're underwritten for, okay? Typical long-term care riders, because of that underwriting that they do on the long-term care, it's typically not available for insureds with higher table rating. So typically anything higher than a Table 4 is not going to be eligible for a typical long-term care rider. All right. Now, I do want to talk about some examples and how to think about this rider just probably a little bit differently than you might be thinking of it. You know, this rider is definitely not intended to replace long-term care. Long-term care has its place, and it's a very good product, and I believe people should have long-term care insurance. To give you a personal example, my husband and I have long-term care coverage. We have 3 years of coverage with shared care. So, you know, I'm thinking about this. What happens if my husband needs to access some of my long-term care benefits for his needs? So that could leave me with 1 year of long-term care coverage. Is that really going to be enough if I need long-term care coverage? If I had this life insurance policy on myself and or both of us, it could be used as a backup. I mean, if that were to happen and I needed some additional long-term care type benefits, I could use this policy to access some of those benefits. Okay, so that's a really good example. It's not intended to be, you know, the only type of coverage that the client has, but it's definitely good as a backup. It's also great if a client, maybe they have a long-term care coverage, but maybe they have just $100 per day, something that you know that is not going to cover them with the rising cost of long-term care. So 10 years from now, when they need that coverage, it's not going to be enough. But if they had this life insurance coverage with this rider, they could access some of those benefits if they needed it. Okay, so think about that as well. Also think about maybe the clients that do have long-term care that need more coverage, but maybe they can't qualify anymore for long-term care. Maybe they've had a knee replacement. That could kick you out from getting long-term care, where qualifying for a life insurance policy, a knee replacement is not going to kick you out or make your life insurance policy a decline. Knee replacements happen all the time. And then you always have those clients who say, you know, I don't want to pay for long-term care insurance because I don't really know if I'm ever going to use it. So I really just don't want to pay for it. So with the life insurance coverage, everybody needs life insurance, and everybody needs more life insurance than what they have. That is what LIMR has been saying for years, and that's what the audience is saying. With this life insurance, with this chronic illness rider, if they don't need the rider, they're not paying for it because the rider doesn't cost anything. It's included with the policy. The only time that they're charged for it is if they use it, and then we apply that actuarial discount when they do access the benefits. All right? So a really great way to think about that. I do want to cover one other thing with you. This is a case study that I want to talk with you about. All right, so let's just say there's a husband and wife, and they're both about 50 years old. They just purchased a new home because they needed more space, so they know they need more life insurance, especially because of the new home and the higher mortgage. They've also been watching John's parents, because John's parents are struggling to take care of his grandmother. She doesn't have long-term care insurance or enough money to pay for a nursing home or assisted living, so they're doing whatever they can to help her out. So they see the strain on John's parents, and they really don't want to do that to their children in the future, so they really want to buy some long-term care insurance, but they don't know how they're going to afford it because they really need more life insurance and they need long-term care insurance, or they want long-term care insurance. So they talked to their insurance agent, and he compared both types of coverages for the couple. So what the agent did, he looked at long-term care, $3,000 monthly benefit, 3 years, 3% compound inflation, preferred non-tobacco. So he came up with some rates at $57 for John and $92 for Ann, so a total of $179 and some change. Excuse me, $149 and some change. Then he looked at our guaranteed universal life. So he looked at $500,000 for both of them that are guaranteed to age 100. And then that would give them, if they needed to access chronic illness benefits because they were unable to perform 2 of 6 ADLs, they have a total of $400,000 they could access. Now look at the premiums. Now this life insurance is whole life insurance, so the premium for John is $389, and for Ann it's $320. So for both of them, that's a total of $710. So, you know, they're looking at a total cost for both coverages of $860. So what happens? Okay, they like the idea of both coverages, but they really just don't know how they're going to afford it right now because of the new house. So their insurance agent, what he did, he talked to them about purchasing the long-term care coverage, but also purchasing a term life answers product from United of Omaha. And the reason he did that is because the term life answers product has a conversion privilege that will allow them to convert to any permanent coverage that United of Omaha offers, including this guaranteed universal life product. So just think about that. If they have our term coverage, they can't afford permanent coverage right now, but if they purchase our term coverage, if they have the opportunity to convert it to our universal life within the first 20 years, and they're guaranteed to be accepted. So if their health changes, you know, that's fine. They're going to be issued at the same risk class that they were issued at on the term coverages, and they would automatically get the chronic illness rider. Should in the future they need to accelerate, they could do that. So what happens to the premiums then? So when you look at it, the long-term care, of course, stays the same, but the premiums for term life is a lot lower, of course, than for universal life. So for term life answers coverage for both of them, it's going to be $310, just shy of $310. They're going to get $500,000, 30-year term coverage for both of them. So that brings the monthly premium for both coverages to $460. So that's $400 difference. They realize they can pay for that. So it's not that you're just selling a life insurance or you're just selling long-term care. You really have to think about the big picture and the needs of the clients and how to make sure that they're covered in all ways that they want to be covered and yet affordably. And this is a great option for them, especially with our term life answers product, which again is just a straight term coverage. But what sets it apart is the conversion privilege that allows them to convert to any permanent coverage that United of Omaha offers. So keep that in mind. Okay. So that's all I had as far as the presentation. So I'll turn it back over to Mike to see if there's some additional questions.
We did have a couple questions here. Hang on for a second, and let me get down here. The term life, one of the ones we had was the Term Life Answers platform. That's available in California in some way, shape, or form, correct?
Yes, it is.
Okay, and then there were some questions about the details regarding the costing and such on the rider, whether it's a fixed cost or whether it gets charged every time they accelerate. I'm presuming that the acceleration process is probably a one-time thing.
Okay, so the way that works is there's no charge for the rider itself. Okay.
Right.
So
right.
what happens is when they want to accelerate, or if they want to accelerate, that is when we apply this actuarial discount. Okay. So in this example, $100,000, the total we're going to subtract from the amount that they accelerated in this example is $13,500 plus a $100 fee. So they're going to get a check for $86,400. So that's the only time that there's a charge for this rider is when they want to accelerate. And that is a charge that occurs each time they accelerate.
Okay, but it's taken out of the, it's basically pulled out before the money goes to them, so it's not an ongoing deal. It's a one-shot deal at the beginning.
You're correct.
Perfect. Okay. All right, great. Well, let me get everybody unmuted here real quick. We'll open it up for questions, so hang on. All right, as we unmute, folks, I'd like to remind you that we are trying to record this, so if you're not going to be asking questions, but you are unmuted, please go ahead and hit *6 on your phone individually. That will mute you so that we don't get background noise from tea kettles and barking dogs, alarm systems, etc. So I will go ahead and open it up for folks for questions. Please jump in. Anything that you've got for Sandy on anything that she covered this morning. And again, thanks, Sandy, for making your time available. I know you just came back off the road, so you're trying to catch up. That's always one of the dilemmas of travel for business is there's a lot of things to dig out from when you get back.
Oh, yeah, no problem.
Sure. Any questions out there? Wow.
Mike, I have a question. This is Sean Jensen.
Good morning, Sean. How are you?
Hey, good morning.
Good. Fire away.
My question is related to what you said. Looking at your hypothetical example, and then it shows the remaining accelerated death benefit and the remaining face amount. So if the insured then wants once again to request an acceleration cash benefit, let's say that they used the $100,000, so they want to do it again. Is there any limitation on how many times they can ask for an accelerated benefit, and are there limits to how frequently? In other words, could they take out $50,000 every month for 6 months, or does it have any limitation as far as time or amount?
Okay. The limitation is that they can only accelerate once a year, so they can't accelerate monthly. So let's say they want to accelerate they accelerated in January of 2014. They have to wait till January of 2015 before they can accelerate again. And the amount that they can ask for is based on the IRS per diem, and which for 2014, that IRS per diem is $120,450 per year. So they can't ask for more than that. We won't allow it. But we want to avoid tax consequences for the client.
Okay, great. That's a good point. I know that that was a big question. I saw Sandy present on this topic at some length in Kansas City about 2 months ago, and that was a big piece of this whole thing when you take these larger chunks of money is keeping the clients out of tax peril. Having that built in is a great way to make sure nothing like that happens. So, all right, any other questions here this morning? Okay, well, we're going to go ahead and take that as a job well done. Sandy, if you'd be so kind as to send me over either the slides or the PowerPoint. We always get some requests for that. Folks, you can shoot me an email, and we'll get you a copy of the slides. This is intended for producer use only, but it's a great way for you to kind of stay sharp. The recorded version of this presentation will be uploaded to our website within 2 hours, I would say by midday Pacific time. And given that we don't have any other questions, we're going to go ahead and wrap this up. Sandy, again, appreciate you making your time available. Thanks, everybody. Have a great day.